Welcome to Ready, Set, Real Estate, where we will help empower and educate you on many different aspects of real estate, finance, and investing. Each week, we will expand your knowledge and uncover hidden truths. We will break down real-world scenarios and study actual how-to strategies. Anyone can buy real estate, but together we'll ensure you make smart real estate investment decisions. Now, here's your host, award-winning author, international speaker, and real estate educator, Lisa Gillett.
Happy Wednesday, wherever you are on this phenomenal planet. So of course I have to do sound check because I've been messing with my mic. So let's make sure that my mic works. Last week I tried, so I had this new mic. Okay, hold on. Before I get into my story, let's just make sure. Say hi, say hello for tuning in on the live, of course. Press 1, lets me know you're here. Press 2, lets me know you shared it. We've got a great topic today. We are in episode 209. So 209. Can you believe that? It's like 209 episodes already. Okay, so let's get to the nitty gritty. Let's make sure. 209. Okay. Mike sounds good to me. Sounds good to me. I was just reading this message from my IP attorney, intellectual property. So we continue to expand our protection of the Ready, Set, Real Estate trademark. And I just saw his text message. So I texted him, I was like, I'm getting these emails that the Chinese denied my trademark, my international trademark application. And he's like, yeah, it's no big deal. What do you mean it's no big deal? Let me see. He says, no big deal. I'm going. Okay. Yeah, we know that. So, and that's true because I did speak with a billionaire. So a billionaire had shared with me, when you deal with trademarking, and he's like, doesn't really make sense to go after people with no money when it comes to marks or any litigation, right? If they're judgment proof, like you're spinning your wheels and wasting your time. So yes, you can go to the extent of protecting your assets. However, there's the reality of some people, just like you said, I'm going to do what they're going to do anyway, and you can tie yourself up in litigation. In any case, let us continue. I'm excited about today's show, especially because I have more clients that I've been consulting. And as you make the transition from renting to buying, not really quite understanding the difference between, a single rent payment and then now this thing called mortgage, the M word, bum, bum, bum. So we'll be talking about mortgage payment versus rent payments. This is not a discussion about mortgages, why it's better to own a home versus it's better to rent, or I'm not discussing pros and cons regarding home ownership and rentership, because everybody's situation is different. This is a real estate literacy show. I'm not a home ownership advocacy show. I'm a real estate literacy broker and educator. And from what I've seen I think I'm in year 17, people will choose not to own real property for very various personal reasons. And it's got to be okay. Because here's the reality. If you are all homeowners and you're owning, property and you have no renters, then you'll have no rental income. Let's think about that. If you are all homeowners and no one is a renter, then there's no rental income. So I'm turning off okay. So there's everyone serves their purpose. Those who are in rentership, we'll talk about where their rent payments go. I'm going to discuss an overview. So good news is this is classroom style today. So make sure I've got a presentation. We're going to discuss the breakdown of where the mortgages go, what's in the mortgage, where that all goes, and then rent and rentership. And of course, this is so you can make an informed decision as to whether home ownership is the best thing for you at this time, or rentership is the best thing for you at this time. Everyone comes to their own moment at a different time. And I am an advocate of allowing people to evolve and grow at their pace. Okay. If you have to wake up and go to work at 2 o'clock, then you'd be pretty upset if somebody's waking you up at 6 o'clock in the morning. Okay. Right. You'd be upset if someone said, get up at 6, you got to get up. And you're like, why? I don't have to get to work to 2 o'clock in the afternoon. What are you talking about? So be mindful. Be mindful. Not everyone's out. It's at the same pace. All right. Good stuff. All right. Let's jump into how you've all been. Let's check in on your real estate goals. I'm really happy. I had like this slow to go type momentum in the first quarter. I was feeling pumped. I was really more excited that I was on top of my school goals. Definitely still had some things, in the pot cooking and simmering. Now my pot is stewing. Right now, I'm feeling it now. So we're in second quarter. I'm glad, and it might be May Gray. May Gray might be contributing to it all as well. This extended winter, spring, grayish mist, drizzle, rain type weather has not really had me as motivated. Last year around this time, it was pretty warm and things were jumping off. Not so much this go round. A little bit slow, but nevertheless, everything is good. So that's my take on just kind of momentum, energy. I'm still sticking to my goals. I'm still writing them down. I've got my Go Girl planner. Let me grab that for you because I've got to update my stuff today. So I've got the Go Girl here. Boom. Right. So I've got my handy planner and I'm mapped out already till next year. So I've got all my activities that I'm supposed to do. And my 3 focus has been school, marketing, and working out. The working out includes moving my body, eating healthy. My husband and I have been doing juices and veggies with exception days. So we'll pick a day where we'll do an exception and we might have something, like a pastry, or like the other day we had, chow mein, right? So noodle and stuff like that. But on a regular, I must say, I am seeing results. I'm happy about that. So marketing, I've still actively been marketing, even though the market has shifted. As a business owner and entrepreneur, we talked about expense optimization. So yes, cut down on the expenses where you can. I still need to go through some stuff because I just got dinged for something that I know I'm not using. I think it was $99. So get to the expense optimization. So marketing for me is the farming. I still farm the area, physically go out. I do postcards, podcasts, and I'm doing the workshops. So still having the monthly workshops. And then my third focus is school, making sure that I'm a better student and I'm on top of my assignments, which I am. So I'm doing a case brief a day. I'm almost done with case briefs. I'll be done in June. Let's look at this. Let's look at my calendar. There's no need to guess. I should be done. And then I've got to move on to my thesis papers. So come June, open June 20th, I'll be done with that. Good stuff. So that's my focus. Simple. School, marketing, and workout. School, marketing, workout, marketing, school, workout, school, marketing. Keeping it simple for me. And it's working. It's helping. All right. What else needs to be shared? So write down your goals. I shared that I'm writing it down. Gets me closer to execution. I think I shared last week. My husband came into the office. He was on the whiteboard, on the glass board, and he had this moment, which he knows this works. He was like, "Wow, this stuff really does work," because he put up his goal on the board to be licensed, He put when he wanted to be licensed, that is being a real estate salesperson. So he has officially been issued his real estate license. So shout out to him. Kudos to him on getting that done. Okay, what else needs to happen? Disclaimers. And before I jump into disclaimers, I definitely want to do a shout out to today's sponsor. Who is sponsoring our episode? Oh, shout out to Anthony Lee, co-author of the Investment Blueprint. We'll be right back after the sponsor break. All right, good stuff. Okay, so let me go ahead and share my screen. And of course, if you're on the live, make sure you say hi, say hello. For those of you who are new to me, my name is Lisa Gillett, also known as Super Agent, broker owner of Devenio Estates. We're a boutique real estate brokerage in Southern California. I am a pricing strategy advisor, short sales and foreclosure certified and experienced. Definitely enjoying my niche area of probate and working with our senior community. So I also hold that senior real estate specialist designation, which all of that means is I'm trained, experienced, and keep up my continuing education so that I am providing not just good services, but supreme. I was gonna say superior, but I like supreme. So I fell on supreme. Supreme services, right? Superior services for our clients to enjoy. Shout out to my clients who have recently closed. Shout out to those of you who just gotten your pre-approval. Shout out to those of you who are getting through, right? Getting through this journey. So I think I decided to use this. I'm going to use this slide as a talking point for when they ask me. Let's say, did you catch the episode where I was talking about the mortgage? Okay, so present view, present. Okay, cool. I'm doing a screen share. Share your screen. Wonderful. Start from the beginning, not the end. All right. Wonderful. I've just been vibing to this green lately. What is green? So green, that's the heart chakra. So I guess I'm just feeling so in love, and I'm enamored with love and life. And that is true. I'm enamored with my journey. Oh, y'all know, I've been through some stuff. Haven't we all? And to get to this space and place in life, I am so grateful. So grateful. Before I do that, because I did mentioning green, it made me remind of our event. So we've got a workshop coming up. So our real estate workshop is happening this Saturday. And let me share that tab real quick. So let me stop that one. Let me bring this one. Let's talk about this one real quick. So we do have an event coming up this Saturday. Definitely make sure you register at realestatelife.events. All of our events will be happening at realestatelife.events. So make sure you register. I'm going to drop it here in the tab in the chat box. If I know how to say it, realestatelife.events. Boom. So we'll be talking about how to undo a reverse mortgage. Again, talking about this intergenerational conversation and shift. We are looking at, I believe we are in the second phase of this wealth transfer happening with our senior population and owners. So we're in the second phase of wealth transfer. There's something of like some crazy $1 trillion of assets that will be transferred from now. It has been happening already. Like I said, we're in the second phase, and then we should be hitting the third phase. But in 2025, we'll hit the third phase. We'll begin the third phase. So we're approaching the end of the second phase in this wealth transfer happening between our boomers, our baby boomers, and transferring those assets to our what's the generation? What the Gen X, Gen Y, Gen Z, and then I forget what they're calling the generation afterwards. You get it, right? You get it. So we are having this discussion because what happens is grandma, grandpa, aunt, uncle might likely be considering a reverse mortgage as a way to supplement their retirement option, right? It allows them to age in place, it allows them to still maintain the house, be in the family home, and not have to worry about making mortgage payments and run the risk of being foreclosed on for non-payment of their mortgage. So the reverse mortgage is exactly that. It puts it puts the mortgage in a reverse process. What that means is they have an option of a single lump sum based on, I believe it's 60% of the property value. I think that's how they might go as high 65%, I think, of the property value. They get that lump sum, one-time payment, boom, right into their bank account, usually wired or a check. And they use that money to live off of. Then their responsibility as part of the reverse mortgage is to maintain the property insurance and the property taxes. Now, sometimes they do forget. Sometimes, as life goes on, they may not be able to manage paying the property taxes and property insurance. And when you miss those payments, what happens is the reverse mortgage lender or the note holder will send a notice and say, hey, looks like you missed that payment. We're giving you a reminder, an opportunity to make that payment. If you do not make that payment, we will exercise our right to do one of two things, right? We'll go ahead and make the payment for you, but now we've got to ding you, right? So now we charge you more. And they can do that. Oftentimes I get that phone call from my senior clients who have reverse mortgages and say, oh, the lender said that they're going to charge me for insurance. And in fact, they will do this even if you don't have a reverse mortgage. They will also do it on a forward mortgage as well. Why? Because the property insurance, as we discussed today in mortgage versus rent payments, property insurance is very, very key for asset protection, especially when you're talking about a lender who has a loan on a property. That is how they protect their collateral. Okay, very important. And so we'll be discussing this Saturday of how to avoid foreclosure upon the death of a senior borrower, because the reality of it is the reverse mortgage is due in full within 30 days of the death of the deceit of the borrower. So senior borrower, homeowner passes away. That is, of course, under the assumption if there is no eligible spouse still alive and occupying the property, then the loan becomes due and payable in full. One of my lenders used to say that essentially for reverse mortgages and in this scenario, you have to have somebody, right, your heir, your next heir, beneficiary, or whoever now wants to take over that property, teed up, right? Like teed up and ready to go to be able to qualify. So we're going to get into that. It's a very important conversation that I really enjoy having because it opens the world and it opens this space for people to be non-judgmental of the property owner, senior borrower who took out that reverse mortgage. They took it out for a reason. Especially if you're someone who may have been occupying that property when they took out the reverse mortgage. And it was likely because there was a shortfall of finances coming in to pay the forward mortgage. That usually is a scenario, not, they're being generous, they're not charging family members rent, but they still have that liability of the mortgage. They're still responsible. And when they retire, that usually means almost a 30% reduction in their income at times, depending. And it could drastically affect their ability to make their mortgage payment. So whatever the reason, whatever the scenario, again, I like to come from a space of non-judgmental, right? Of being non-judgmental as to why someone opts for a reverse mortgage. But I think it's important to understand that just because you did the reverse mortgage doesn't mean that the property is no longer yours. It is still your home. It is still up to you whether you want to keep that reverse mortgage or would like to do other things. So I feel like it's an important conversation, and we'll continue to have that conversation as time goes on, as long as I have breath and speaking parts. All right. Shout out to those of you who are tuning in from ERGJ Enterprises. Of course, we've got a great group over there happening with the BBC. I know ERGJ, my brother Evan Jefferson, has brought the book club back as well. Okay. So make sure you sign up, realestatelife.events. Shout out to those of you who are listening and tuning in on our radio podcast as well. Okay, let's bring back the class. Mortgage versus rent. Like I said, we are in episode 209. And essentially, here's a quick overview. Again, this is not to discuss mortgages and renting or home ownership and renting in the light of one being better than the other. It's just in the context of where your money goes when you send out those payments. Oftentimes, my new home buyers don't realize kind of the flexibility they have with making their mortgages, not so much with rent. And an example being your mortgage payment is current until the 15th of each month. Day 16th, it is considered late. Can't do that with your rent, right? Depending on what your rental agreement says, you're late. Your rent is late if paid past day 3, and you're charged a late fee. And it could be late fee per day or whatever the stipulation is in your contract or lease agreement. So let's look at it as a summary. The mortgage overall, right, would and because I'm not discussing this in a pro versus cons, we're going to talk about the benefits to each as an overview. So mortgage or home ownership provides you just that, the benefits of home ownership, and comes with that personalization. Data statistics usually have shown that children raised in a home or within home provides more stability. They perform better in school. I remember that as a psych major. So that's my major in psychology. And we were just kind of studying how density affects children and children's behavior, or not just children, but people's behavior. Of course, when we're in communities where there is a high population, or I would say a high amount of units, right? Rental units, multifamily, we've got high density, and there's a lot of stressors that comes with that. So one of those things in terms of looking at mortgage versus rentership is in terms of environment. The second thing that comes with a mortgage, of course, is equity building. So, of course, as you pay down your mortgage, right, the amount you owe or have borrowed on that property, you build the equity. You build up the equity. You get that nice little bonus equity. That you get the nice bonus of appreciation that comes with inflation, 2%. What are we at now? 3%. And of course, you get the benefits of tax deduction. So writing off the mortgage interest deduction, writing off property taxes. Of course, the laws have changed. So there are caps in terms of how much you can write off. And I'll remind you, you can write off or deduct the mortgage interest up to loans up to $750,000, and property tax deduction up to $10,000 annually. And this benefit of this benefit of fixed payments, just knowing that what your mortgage will be. I have this nice little asterisk by fixed payments because I did an episode talking about kind of myth busting, or the misconception that your mortgage is going to be fixed or the same for the life of the loan. And anyone who has a mortgage knows that that is not true. Oftentimes people don't say that out loud though. I don't know why. Everyone's like, your payments will be fixed. No, your payments for your principal and your interest is fixed for the life of the loan, but your overall mortgage payment is not, subject to variations in your property taxes and your property insurance. And we'll get into that shortly. As far as rent goes, you have the ability to establish a good credit score as long as you pay your rent on time, and as long as your landlord or the property manager has enrolled that property into credit reporting, at least reporting to the credit bureaus. As a second benefit on the rentership is it gives you a record of consistent payments for future loans. For when you apply in the future for a loan, at least you have a record of consistent payment. So if you may not necessarily are able to capture your rental payment history in the form of a credit score, you can at least use the consistency in your rent payments as what we call a non-traditional form of credit scoring. A non-traditional form of credit scoring is not a new thing. I know with social media, you'll hear and see a lot of things and think these are new things, but these are not. These things have been around for a long time. Just comes with experience, and it just comes with connecting with real estate professionals, advisors, consultants who are, I would say, lead with education so that their clients are informed. So those are the differences, I think, versus someone who's a salesperson and is in this business just for sales. And the third option is flexible payment options on the rentership side. So not so much on the mortgage side. You don't get to cash app, at least not yet. I'm hearing these talks of these bills that are in place as it relates to cryptocurrency and cryptocurrency mortgages. We will continue to explore those conversations as they develop. But for now, on the rentership side, you do have the option of flexible payment options where you can cash app or Venmo your rent payment. You can Zelle, right? You can Zelle or use some type of e-pay processor to send your rent payments. Not so much on the mortgage side. They usually want you to send that in the form of an electronic debit from your bank account, cashier's money order. Definitely cash is not an option, and they have not. I don't know any lender that's accepting Venmo or Cash App to pay your mortgage. And the fourth one is it simplifies budgeting. When you're a renter, rentership is a very predictable expense. You know what your expenses are. There's no surprise. Unlike on the mortgage side and the ownership side, you can have those unexpected expenses like maintenance and repairs, capital expenditures. So I like what we're seeing and discussing here in terms of those pros for your mortgage payments versus your rent payments or rental payments. Now let's talk about where your mortgage payment goes. Where exactly is this payment going? So your mortgage payment is broken out into 4 to 5 items. It's one payment broken out into 4 to 5 items. And I have a separate slide to talk about that fifth item because it warrants its entire own slide and conversation. Melanie Peters is in the building. She says, "Hi, Lisa." Hi, Melanie. Welcome and thanks for catching us on the live. The best way to remember and write this down in the chat is PITI when it comes to your mortgage. PITI. No, we don't pity you that you have a mortgage, but in a good way. PITI. The P stands for principal. The I stands for interest. And the T stands for taxes, as in property taxes. And the I stands for insurance, as in property insurance. Good to see you too. And what's in your mortgage is the PITI. So the principal is the amount borrowed. We're discussing the amount borrowed. Now, whether you inherited this property with a mortgage, it was the amount someone else borrowed. It's just the amount borrowed. Whether the house is free and clear of a mortgage, that means there are no mortgages. When we hear free and clear, that means no mortgages subject to the property taxes and insurance. Free and clear means no liens, meaning no home repair loans, no solar panel financing loans, none of that. Free and clear means there are no liens, no loans recorded against that property. If you refinance, that means, and I had such a young inheritor. She was an heiress, an heir to her grandmother's estate, and she inherited 3 out of 12 properties. I think it was 4 grandchildren, they each got 3. She was on her last property. She had sold the prior 2. And at 23, 24 years old, that's quite a crash course, not just in life, but in finances and property and home ownership. And it's just amazing when we look at generationally what some of our ancestors have done to build up their assets and build up their net worth and build up having a voice as a taxpayer, as a landowner. And oftentimes the next in line or the next generation to inherit is not clued in on something like this. So this conversation is very important today, just on the conversation of mortgage payments. Like, that is your responsibility. If you inherited a property and you're getting a mortgage bill sent to that address, regardless if you change your address, doesn't mean that the bill goes away. It doesn't mean that the debt goes away. It doesn't mean that the obligation stops just because you stop getting the mail or you stop opening the mail. It still exists. And oftentimes that's what I've seen. People don't open the mail. They feel like, if I don't open the mail, then I'm not obligated to pay it. Doesn't stop the lender from saying, you know what, we've made some attempts. We're going to go ahead and pursue you in a foreclosure action, and we're going to go ahead and auction this property off to collect what's owed to us. That's how we get to that point, is the mortgage payment. As long as you pay the mortgage, you pay it down, you don't have to worry about the lender saying, hey, I'm going to have to use the property as collateral, which is what is agreed to in the contract, in order for them to collect the monies owed to them or borrowed from them. So the amount borrowed is the principal. So you pay a portion of that. The cost of borrowing is called the interest, and there's a portion towards that. What's really great is this breakdown is itemized on the escrow document. Then you have your property taxes. The government levies taxes to provide taxpayers with things like, you guessed it, schools, police, fire, garbage collection, and may also include other infrastructure. This is why there's a close relationship between homeownership and schools, right? How well they have resources, funding, how well the schools are performing is because the property taxes in that area go towards the infrastructure, the school, the police, etc., for that area, for that community. So I'm sure you're having that moment. You go, oh, that's why some schools are quote unquote nicer or have books or have XYZ. And it's because there is a relationship between homeownership and the infrastructure in that area. Nicer schools, the police station even looks different, right? I have been doing this with my son and showing him different libraries, showing them how the libraries differ in various neighborhoods. We've gone all the way to Manhattan Beach, Torrance Beach, been to PV, we've been to a couple in South LA, East LA. We've been down to, of course, the one, the large one, the main one downtown. And so he gets to see just kind of what money does and pouring into the infrastructure. So you've got that. So property taxes serves its purpose in that way. Then you have the property insurance, which is essentially asset protection in the case of a fire and or flood, recovers damages to the property, subject to the policy limits and its coverage. So you've got to check, because if you recall a couple years ago when Texas had that flood, some parts of Texas, had that flood. And I realized Texas is large and not the entire state of Texas was underwater, but there were communities, and I forget which one specifically, had that really bad flood recently. And they said the people just, it wasn't an area that had ever been zoned or recognized for flooding. And so, although people had an option to pay $60 to $80 a month uh, extra in their property insurance for flood insurance, they chose not to. It was an option not to pay for that. Now, here in California, there are some areas that during the escrow process or the settlement process when you're purchasing, the buyer will come to know whether an area, that property is designated in an area of fire or flood, because it will cost you an additional premium to insure or properly insure that property with a certificate, right? Getting that flood certificate insurance on the policy. So that's what's included in your mortgage payment: the principal, interest, property taxes, and property insurance. So, question. So, Lisa, do I have to make 4 separate payments? No. It's one payment you are sending to the escrow holder. That is the person who's managing the accounting. And this goes back to my question, right? Pop quiz, knowing the difference between, I had it on here. So, oh my gosh, I got to bring the banner back. So, know the difference between your mortgage servicer versus your what? Your mortgage lender. They may not be the same. Your mortgage lender may not be the one that is collecting the payments and handling the accounting. It could be your mortgage servicer. So, important to know. So, you make that payment and you're sending that off. And because you're dealing with a mortgage servicer as a third party, you want to make sure you're looking at your mortgage statement so that the accounting is also correct. Yes, they've got systems and people, but we know systems and people can have their moments of hiccups and errors. So make sure that your payments are being applied accordingly, especially if you're taking on the recommendation of adding an additional payment. Once you've paid your regular mortgage payment and you send an additional $50, 80, $100, and you're sending that as an additional towards your principal, you want to make sure that's being applied. You want to make sure that's something that your lender is allowing you to do, because oftentimes what they'll do is put it in a suspense account. If you don't provide specific instructions, they'll put it in a suspense account, or they may just go ahead by default and they can say, well, the contract says if any payments or extra payments received without any interest, thereby you're not reducing your principal balance or the amount borrowed. Okay, good stuff. Let's move on. Now, this other item is part of your PITI, and it can be PITIII, is the additional mortgage insurance premium. Now, this is not a borrower benefit. Like property insurance, homeowners insurance is asset protection for you and the lender in the event of damages to the property. I was watching, like, near where we live, there was 2 houses. One house caught on fire. They were so close and the fire jumped to the roof of the other property. So both properties caught on fire. And it was really interesting to see the timing of when those properties started to get rebuilt and new roofing. And so it was really interesting how the one that was not as badly burned, or the one that was really badly burned, I think started their construction or reconstruction later than the neighbor's property. So, that's an insurance thing. Same thing with when we don't weatherize our property and we switch from warm seasons or hot seasons to cold seasons, and you're not actively, or you're in a cold area, or you're not actively running water, not actively using the systems in your house. And when you do that during a cold season, you run the risk of a pipe bursting. When you have that, now you've got flood happening and an insurance claim, that kind of thing. So might want to look into that in terms of your coverages with property insurance. So that's what I'm not talking about that right now. what I'm discussing is what happens if you put less than 20% down. It's called a risk premium, and it's an additional mortgage insurance premium added to your monthly payments. Now, there are a couple payments that are common, or excuse me, there's one that is common that most of us see all the time, and it's this one right here on the far right. The Federal Home Loan Mortgage Protection, also known as the MIP, Mortgage Insurance Premium. This one's very common because most property owners, first-time buyers, those who are jumping in the market with less than 10% down are utilizing an FHA insured loan. So a government, one of the government-sponsored enterprises or entities allows you to purchase a property putting less than 10% down, less than 20% down, but it comes with a mortgage insurance premium that remains for the life of the loan. Doesn't allow you to cancel it, even if you hit 20% vested in equity in that property. You will actually have to refinance to cancel out the mortgage insurance premium if you're utilizing an FHA loan. Now let's jump back here to the far left where I'm talking about the borrow paid mortgage. So the borrowers can pay or will pay a monthly mortgage insurance premium also included in their mortgage payment. You'll see it as a line item, and they'll pay this, usually if it's a conventional loan, they'll pay this until they reach 20%, and the lender may automatically, in recognizing that you've reached 20% vested in the property, that means that's your equity share of the property, they will cancel the mortgage insurance. Know which type of loan you have because it's not always the case. Then there's a single premium mortgage, of course, where you can pay for it up front or finance it into the mortgage. And that'll essentially be a single financed mortgage premium. Not common because, again, home buyers who are putting 20% down usually don't have additional funds beyond down payment and closing costs for things like the single premium mortgage insurance. Not being able to pay that. Very few. I have had some clients pay it up front. And you can just ask your lender, how much is it? I don't want it spread across my mortgage. How much is it? I'll pay it one time. And the reason for doing that is to lower your monthly mortgage payment. Then this option here, which is the lender paid mortgage, is oftentimes when you hear the lender pitch their products with no mortgage insurance. So if you are utilizing a loan product and putting less than 20% down, it has mortgage insurance. However, one of four things are happening. In the case of the lender paid mortgage, that means the lender pays for the mortgage insurance. However, you may pay for it over the life of the loan with a higher interest rate. However, more howevers, right? However, it may still benefit you or afford you a lower mortgage payment than if you had a mortgage insurance premium added to your mortgage. So it still might be a better deal. Not all lenders offer this. You've got to check with the lenders. Again, not all lenders offer this type of mortgage insurance premium option. Okay. Schedule and deadlines. If we talk about rentership versus our mortgage payment. So rent remains the same subject to rent increases. So you can go in this example, January, March, May, your rent is the same until the owner at their discretion raises the rent subject to any rent stabilization ordinances or rent control ordinances for that area. If you're not subject to rent control, that's when you start to see people experience some stressors because their rent has gone up $100, $150, $200, something exorbitant that forces them to now have to relocate. So aside from you just making one payment in your rent, the only thing you'd be concerned about, of course, is the increase. Being hit with that increase, not really knowing. And some people can be triggered by that change. Some people can be fine with it knowing that it's possible. So know that with the rent, it remains the same subject to any rent increases. Your mortgage, not so much. You have the increases subject to any property assessments, meaning if the property taxes increase or you change your policy, your property insurance policy, and your insurance coverage changes, or there's an increase in the renewal premium, then you'll see an increase in your mortgage payment. So, where does your rent payment go when you make your rent payment? Well, it goes in a couple places. Let me, it goes in a couple places. Bring it back for us. Let me get out the way too. Your rent payment goes to the property owner, right? The landlord. The landlord then pays the mortgage, if any, on that property that you're renting. Where does your rent payment go? So it goes from the mortgage to the property owner for the mortgage. The landlord will cover their share of utilities, the use of the water, gas, and or power, depending on what the contract terms are with you as the renter or the tenant. Your rental payment also goes towards a cushion or savings in the event for maintenance and repairs. Because you may say, I'm glad I don't have to fix anything. I could just call my landlord. But your rental payment essentially is covering it, as long as the landlord is doing proper accounting and not living and splurging off of your rental payments, as long as there's no mismanagement with the funds. That your rent payments over that period would go to pay for, roof repairs, plumbing, lawn care, pool care, any request for maintenance and repairs. That's where your rent payment goes. That's why you hear the logic for people say, you're not really paying rent. You're still paying mortgage, but you're paying someone else's mortgage. And essentially that's where your money's going to. That's the argument, right? That the money is still going towards mortgage. Where some tenants or some renters may say, well, my landlord says he has no mortgage on the property. Where's the money going? Well, to their cost of living, to maintain their lifestyle, maintain the property, and any share of utilities that they may have with you. That's where it goes as well. So see how your mortgage, let's go back to your mortgage payment. Your mortgage payment goes, one payment covers principal, interest, property taxes, insurance. And I didn't include still having a cushion or have a savings for home maintenance and repairs. The mortgage may also include the mortgage insurance premium versus your rent payment, one payment, and the landlord is taking care of all those costs and services. Got it. Good stuff. All right, so we're on time. I like this. We're on time. Any questions? Reach out, of course. You can send me a direct email. This is my direct work email, lisa@lasuperaagent.com. You can connect with me on your favorite social media platforms at LA Super Agent. And of course, if you would like to call and text right here, you can call and text at 323-488-3265. Again, 323-488-3265. I want to say thank you for tuning in, catching us on a live. Make sure that you share this with somebody. Just reshare, tag them in it so that they have a concept of rentership payments and mortgage payments. This was not a conversation about I'm not here to convince anybody. You do what works for you. You do what works best for your financial situation at that time with what's going on in your life. All right. Okay. With that, I say I'll see you next week for another information-packed episode on Ready, Set, Real Estate. Thank you for tuning in and have a fantastic and productive week. We'll see you next week. Take care. Bye.
Thank you for listening to the Ready Set Real Estate Podcast with Lisa Gillett, the LA Super Agent. Please like, subscribe, and share LA Super Agent everywhere on your favorite podcast platform.